So now let's talk about tariff, one of the most hot topic in today's global economic scenario. Let me explain this using only data and economic impact. First, an important clarification. The 500% tariff is still a bill. It is not been passed and not implemented yet. But if implemented, the economic consequences are several, which is why markets are tracking it. The trigger is oil imports. In FY20, Russian supplies 1.7% of India's crude oil. By 25, this rose to around 35%. This reduced India's oil import bill, inflation pressure, physical stress. But it also increased trade vulnerability because energy sourcing is now linked to export access. A 500% tariff is not marginal. A product priced at $10 lands at a $16 in the US. At that price, export volumes fall close to zero. Economically, this export elimination, not a margin pressure. India already faces a 15% tariff. That tariff is already active, applied only to goods, affects selected items. Export still continues, though at a lower margin. A 500% tariff proposal is a different, section linked, designed to shut trade, not regulate it. The US, India's largest export market, account for about 18 to 19% of total exports. India exports roughly $115 billion in service and $110 billion in the goods. Even if services are not directly taxed, risk perception alone delays contracts, rise compliance cost, reduce dollar inflow. When exports fall, fewer dollars enter in the Indian economy. With the low dollar inflow, the current account deficit starts winding. A wider current account deficit increase pressure on the rupee, leading to higher currency volatility and depreciation risk. At the same time, MSME face cash flow stress, bank face export credit risk, equity market price earnings uncertainty. So the key facts are the 500% tariff is not law yet. It exists due to Russian oil share rising from 1.7% to 35%. It is far more severe than the current 50% goods tariff. The real risk is export, forex inflow, current account deficit, and growth stability. From a finance perspective, this is an export-led macroeconomic risk.
IIP numbers in November came well ahead of expectations at 6.7%, but do remember October numbers were quite dismal. So if I average October and November, there is nothing to cheer about. High frequency indicators are confirming that consumption in the November has remained strong and impetus given by GST cuts continue as we move forward. Our challenge is not one on the trade deficit. That's the reasonable. It's the capital account where net foreign direct investment has become very low and outflows on the capital account through remittance continues. This will be the second year in running where POP will be negative, that is current account deficit will not be funded by global investors. The net foreign direct investment has came down dramatically as companies like LG, Hyundai, Whirlpool have taken out money. On the debt market side, despite getting the call right on the policy side of RBI and US Fed, we have seen yields going up. We have seen our portfolio delivering negative returns on long duration side. Fed recently cut rates in December FOMC meeting, cents for not cutting and 1 cents for cutting more. The divided Fed is still expected to cut interest rate well into 26 as well, maybe 2 times, maybe 4 times. This puts some more sort of cap on Indian 10-year yield. Even in Japan, 30-year bond is reaching levels unseen before. Fortunately, India's inflation has came well below RBI initial forecast. When we started the year, inflation forecast was about 4%. Now inflation forecast for full FY26 is just about 2%. This lower inflation allowed RBI to cut rates in December MPC meeting. They also pumped liquidity through open market operations and CR cuts. Overall, RBI will be pro-growth and supporting banking system to deliver more credit to support Indian economy growth. This is also a likelihood of India getting into Bloomberg Global Aggregate Index. If that happens, we could expect a couple of tens of billions of dollars in terms of flow. We have been given an opportunity as Rupee has continued to depreciate against US dollar. This has created a large depreciation vis-a-vis yen, euro, renminbi, and pound. Can India exporters take advantage of this depreciation and export more to the countries? That if that happens, growth will support it in order to contain rupee volatility. RBI has regularly invested in the market, and as we speak, they are totally short $60 billion in rupee forward market. There was a sharp 4.5% depreciation of rupee in CY FY25. Because of that depreciation, rupee is likely to remain range bound in CY 26. Now, let us understand with the Indian case studies. Case study 1, Supreme Infrastructure Limited Highway EPC turnaround. What Supreme was before collapse? Revenue 2,500 crores to 3,000 crores. Order book 6,000 crore plus. EBITDA margins of up to 16% plus. ROC of 18 to 20%. Promoter holding was 46 to 50%. This was Tier 1 highway EPC contractor with queries RMC asphalt plans. Why it collapsed? Supreme made a strategic mistake. They bid aggressively for BOT, that is, build, operate, and transfer highways. They assumed toll revenue would pay debt, but state governments removed toll, reduced tolls, delayed compensation. So cash flow collapsed, but debt interest kept compounding. In FY12, the debt was 1,400 crores. In FY15, the debt was 2,500 crores, and in FY18, the debt was 3,200 crores. 12 to 14% interest cost that rounds to 400 crores plus yearly interest. EBITDA fell below interest bankruptcy trap. Lenders realized if we liquidate, we recover only 10 to 15%, so they choose resolution plans. Original finance debt 2,200 crores principal, settlement amount 464 crores. That's a massive haircut of 79%. That means banks accepted. We forgive 1,763 crores. How 646 crores is being paid? Asset sale of 180 crores. New investors pouring 147 crores. Further asset monetization of 173 crores. That's total of 464 crores. This clears lenders completely. Promoters skin in the game. Promoters injected 800 crores of their personal wealth. This is crucial. If promoters didn't believe in revival, they wouldn't put 800 crores of their own wealth. Bank trusts this. Post restructuring balance sheet. Net debt of 1,000 to 1,200 crores, equity base of 1,600 crores, and enterprise value 3,000 crores. This is now fresh infrastructure company, not a bankrupt one. Case study 2. Nitco Limited. Nitco was here FY12, the revenue was 500 crores. In FY17, it was 700 crores. And in FY21, it was 400 crores. Brand, export network, land bank, but debt kept rising. In FY15, the debt was 1,200. In FY19, the debt was around 2,000 crores. In FY23, the debt was 2,800 crores. Trust was greater than EBITDA, that is, that spiral. Who took over the debt? Bank sold debt to GM Financials. GM Financials sold to Autumn Infrastructure Limited, that is ARC NBFC. Autumn owns 2,800 crores debt. The restructuring plan. Autumn decides instead of bankrupting Nitco, let own it. So they did. Capital injection, promoters 225 crores, investor 350 crores, debt to equity. Autumn converts 1,000 crore debt into equity. Asset transfer, promoters take 100 acres land at 300 crores, real value far higher, remaining by debt written off. Post deal ownership, the shareholders were Autumn, promoters, and public. Autumn held 45%, promoters 25 to 20 to 25%, public rest 30%. Promoters is running the business. This is how real restructuring happens. Real valuation after dilution. Before shares were 7 crores and 18 lakhs. After conversion and warrants, shares were 25 crores and 2 lakhs. So at a market price of 120 crores, market cap is equal to 3,000 crores, not 800 crores. Retail investor often miss this.
Thanks, mate, for walking us through the current affairs updates around important themes. Now let me take you to the AI updates. Let me use this slide to give a quick reality check on where the AI stands in 2026. On the left-hand side, you can see the AI gold rush. There's massive ambition and spending. In fact, companies have already invested around $30 to $40 billion in generative AI. But here's the surprising part. 95% of the firms say they have little to no measurable return so far. So while the excitement is huge, real business impact is still catching up. Now look at it, India. India is positioning itself as a global AI producer, not a user. With the India AI mission, heavy tech investments, the goal is to build AI capabilities at scale. You can also see that the Asian tech stocks are outperforming US peers in early 2026, driven largely by AI demand. So the markets are clearly betting on the long-term AI growth. Now let's move on to the right side, the reality check. Around 40% of the global jobs are exports to the AI disruption. That doesn't mean all jobs may get disappear, but it does mean that job roles will change significantly. At the same time, the AI growth is hitting physical limits. There's a global shortage of high bandwidth memory chips, which are critical for AI systems, pushing cost higher. And finally, the most important point, AI still depends on humans. AI is largely solving problems, but humans decides which problems actually matter. So the big takeaway is simple. AI's potential is enormous, but execution, infrastructure, and the human judgment will decide who really wins.
Hello guys, I'm going to discuss about the India's IPO market, what has happened over the past 12 months. Around 354 companies have listed in the market and have generated of rupees 1.54 lakh crores rupees through these IPOs. Shows that investors are very active and companies are very confident to get listed in the market. Another point is that ESOP. Companies gave ESOP to attract the best talents from the market. So through this IPO, employees also have generated much wealth by converting this ESOP into the shares and selling these shares into the market. So it has generated $1 billion wealth of the employers. Now we look at the investor returns. 72% of the IPO have listed above the issue price, but after the listing, only 50% of the IPO are trading above the issue price. This shows that IPO price has moved after the listing. So the worst performing IPO has fallen by 81% and the best performing IPO was gave return of 450%. Now let's look at the SME market. What has happened in the SME IPO? So earlier, what happens that any companies come and issue the IPO by the hype of the market. But after SEBI come and tighten the rule for the SME IPO, like promoters cannot exit easily and companies operating profit should be more than around 1 or 2 crore over the past 2 financial years. So these were the rules changed in the market. Also, most of the SMEs IPOs are using funds for the expansion and the working capital needs. So this shows that in the SME market, only strong and good companies are coming into the market, and SME companies are performing good in the type in the sense of the IPO market. So in the IPO market, in IPO investing, it is important to look at the good companies which can generate good returns. So now let's look at the commodity market, gold and silver. Gold and silver prices are daily breaking their all-time high. So, what are the reasons of their increase in the prices? For some of the reasons are trade tensions, global uncertainties, US rate cut expectation, because so that the US bond yields will decrease and the people will prefer gold. Also, central banks are buying the gold because they want to reduce the dependency on the US dollar. Now, let's look at the silver. Silver and the gold. Gold prices are very low volatility. The gold prices move slowly and steadily, but silver prices are very volatile because it consists of the investment demand and the industrial demand. Industrial demand means silver is also used in the manufacturing of the semiconductor parts, auto manufacturing, and also in the solar industries. So silver is very volatile because it also consists of the industrial demand plus investment demand. So this was the volatility in the silver. Now, what in the FY 26? big firms, big CEO, big firms CEOs are expecting that the gold and the silver prices will not move this much in the FY26 because now there is a looking at the easing in the uncertainty because US and India's agreement will be signed in FY26. Also, central bank will not buy so much gold at this all-time high prices, and these are the reasons that in FY26 gold and silver prices will not move so much.
Let me explain what this slide is really saying in a very simple terms. For many years, China was the cheapest and the most reliable factory for the world. One big reason for this was the export subsidies and especially the tax rebates given by the Chinese government to exporters. Now one big change which happens is this: China is cutting their exports rebates, starting with areas like solar production and gradually extending battery components to other manufacturing segments. Now, one question will come in your mind: why this matters? Because export tax rebates were like hidden discounts. When Chinese government removed them, China's exports actually costs go up. So, first impact is very straightforward. China's export become more expensive. Once cost rise, China's companies lose some ability to undercut global prices. That means their price advantage shrinks, especially high competitive global market. Now, here where the big global shift comes in. As the cost advantage reduce, the global companies start asking one simple question: why should all our products be concentrated in one country? This where China plus one strategically comes in play. China plus one doesn't mean companies are leaving China completely. It simply means they keep China as one base but add another manufacturing location outside China to reduce risks. That plus one could be countries like India, Vietnam, Indonesia, or Mexico. By reducing subsidiaries, China signaling that it wants to erase global trade tensions and reduce accusations of dumping. So the key takeaways from this slide is simple. China still important, but it no longer unbreakable on the cost, as its advantage shrink global manufacturing is slowly separating out. This is why China plus one is no longer option. This becoming a default strategy for global companies.